And it's halftime into the hour of 1 p.m. That means it's time to give you an update from the world of business. Well, I'm standing in for Will. She was supposed to be here, and that's what I said early in the morning. But here I am to give you an update from the world of business, right on Business Incorporated. I'm Mini John Rekwa. This is what we have for you on the program this afternoon. Kenya and Israel are collaborating. They're sharing farm workers. And 2 southern African countries are integrating. Let's find out the details on the program. Some financing coming the way of Zimbabwe businesses. Good time coming up for them. Welcome. These are the updates we have for you from the world of business. We'll begin with the markets at intraday. As we would normally do, Nigeria is still sustaining that red color. The bearish sentiment, profit taking seems to still be dominating at the NGX this afternoon, 0.41%. The market is down at intraday. South Africa follows suit, 0.39%. Egypt is 0.027%, but that's closed. That's for Thursday's number. That's what they closed with, as well as Kenya. Thursday's number shows 0.11% in the green for Kenya. Moving over to the Middle East, now we see 2 of those markets are closed. Those that are trading today, we have negative sentiment from them, 0.74% for Abu Dhabi at 9,400.75. Dubai is also negative, 0.12% at 3,951.52. We have the other markets that are not trading today. Saudi Arabia closed positive yesterday, 0.46%, as well as Qatar. But Qatar closed in the red, 0.24%, 9,848.15. Let's go to Europe now and see what's happening there. EU representatives are holding talks on AI regulation while a provisional agreement has been reached over rules for generative AI like ChatGPT. Officials are struggling to find a compromise on other issues. Well, we have joining us from Berlin, Chiponda Chimbelu tells us the updates. Chief, good afternoon. So what's the latest about all of this conversation?
Thanks for having me, Inni. Well, we know that the representatives from the 27 member countries and the EU negotiated for close to 24 hours before agreeing to the provisional agreement. And right now, that agreement focuses on regulating generative AI systems, which are becoming increasingly popular. Also, the European Commission would maintain a list of AI models that are deemed to pose a systemic risk. And the providers of general-purpose AI would have to publish detailed summaries of the content that is used to train them. Now, that is according to news agency Reuters, which cited a document circulated among lawmakers. The law may also exempt free and open-source AI licenses from regulation in most cases, unless they are deemed to be high risk or used for purposes that have been banned.
All right, Chip, thank you so much for that. AI is a very interesting topic, and I know that they're talking about the threats to jobs and all of that. Well, I guess what everyone has to do is up their skills, and then you can fit in again, just like we did with technology. Now, still staying in the markets, we go to the United States now, where stock features were a little changed. And Friday morning there, as we speak, as investors looked ahead to a U.S. jobs report. Features tied to the Dow Jones Industrial Average ticked higher by 31 points. That's 0.1%. S&P 500 features were roughly flat along the Nasdaq along with a Nasdaq 100 features. The report is slated to be released later 8 a.m. That's the U.S. time. Economists poll by Dow Jones expect 190,000 jobs will be added in November, or were added in November. Investors have been focused on jobs data, with several reports sprinkled throughout the week leading up to Friday's numbers. Initial jobless claims reported on Thursday came in at 220,000, while continuing claims came in at 1,861 million. That's for the job report. But let's see what yesterday did, how it closed in the market. We have our correspondent, Maria Bird.
The U.S. stock market was on an upward swing on Thursday, as the Dow Jones was slightly up at 0.2%, the S&P 500 up at 0.8%, and the heavy tech Nasdaq led the way, being up at 1.4%. The tech industry is definitely rallying for a positive end to the calendar year, as many investors are also hopeful that this means a good jobs report on Friday, and also means that we are going to see a potential decrease in inflation, and also meaning that we could see a slight decrease in interest rate hikes that we have been expecting over the last few months. But this will only be the test of time when we see the Federal Reserve meeting next week, which will let us know whether or not interest rates will continue to rise or if they will be slightly cut before the end of the year.
Yeah, so all eyes are waiting. In a couple of hours, we should have that jobs data, and every market, crypto market, gold, everybody's looking out for that. Now, Asia-Pacific markets are mixed as Japan's third quarter GDP revised downward, and for the third quarter was revised downward in beg your pardon, in a surprise move. Economists were not expecting that, while India's central bank held its benchmark lending rate steady. Japan's third quarter GDP was revised to a 0.7% fall quarter on quarter, a sharper slide compared with the 0.5% decline estimated earlier. Economists had forecast that the revised figure would be unchanged at 0.5%. The Reserve Bank of India held its repo at 6.5%, and that's in line with economists' expectations, forecast that the bank would keep its benchmark policy rate steady. In Australia, the S&P X200 rose 0.3% and ended at 7,194.9%, reversing earlier losses. Japan's Nikkei 225 tumbled 1.68% after the GDP data to end at 32,307.86, its lowest level in a month, while the Topics fell 1.5% to 2,324.47. South Korea's Kospi climbed 1.03% to finish at 2,517.85, while the small cap Kosdaq advanced 2.11% to 830.37. Hong Kong's Hang Seng Index eased earlier gains to trade marginally low, the flat line in its final hour, while the mainland Chinese CSI 300 gains 0.24%, rebounding off a four-year low and ending at 3,399.46. Look at some commodities now. Oil prices rose in early trade on Friday, but on track to fall 6% for the week, hovering near six-month lows, with investors fretting about weak energy demand in Asia, combined with high U.S. crude production. Brent crude futures rose 68 cents, as well as 0.9% to $74.73 a barrel, while U.S. West Texas Intermediate crude futures gained 64 cents, that's about 0.9%, to $69.98 a barrel. Both benchmarks slid to their lowest since late June in the previous session, in a signal that traders believe the market may have become oversupplied. Brent and WTI also in contango, a market structure in which front-month prices trade at a discount to prices a half year later. Concerns about China's economy have fueled on the oil market on its downturn this week. Chinese customs data showed that crude oil imports in November fell 9% from a year earlier, as high inventory levels, weak economic indicators, and slowing orders from independent refiners weakened demand. In India, we just talked about their rates. Well, fuel consumption in the month of November fell after hitting a four-month peak in the previous month, hit by reduced travel in the world's third biggest oil consumer as a festive boost fizzled. Brent and WTI futures are on track to fall about 5.8% and 6% for the week. Still on commodities, gold prices were on track for their first weekly fall in four after the dollar firmed although they traded steadily on Friday ahead of a key U.S. jobs data to gauge the potential of a rate cut by the Federal Reserve as early as March. Spots gold edged 0.2% higher by $2,031.31 per ounce. However, nearly 2% for the week. It fell by nearly 2% so far in the week. U.S. gold futures edged 0.1% higher to $2,048. Bullion scaled an all-time peak of 2,135 on Monday on elevated bets for a rate cut by the U.S. Fed before dropping more than $100 on uncertainty over cuts trimming. The dollar index was on track to snap a third straight weekly loss, making greenback price gold more expensive for other currency holders. Gold remains well supported above $2,006 per ounce level, but a stronger than expected payrolls data could put this support level in jeopardy. Now, spot gold looks neutral in a range of $2,019 to $2,039 per ounce, and an escape could suggest a direction. Spot silver now, it rose 0.2% to $23.84 per ounce, while platinum gained 0.7% to $913.40, and palladium also inched up 0.7% to $975.88 per ounce. All right, now let's leave the market and see what's happening with economies and among countries. We begin with Zimbabwe and Botswana. They are working to eliminate passport requirement for travelers between the two countries, a move that could boost regional integration as well as trade. Zimbabwean President Emmerson Mnangagwa said that this agreement with Botswana was given during the festival which was held in Botswana. Well, the that's president of Zimbabwe, said that the two leaders had instructed their officials to clear any legal obstacles to the passport-free travel. He said the decision was motivated by their shared African identity as well as vision. Still in Zimbabwe, the African Development Bank, that's the AFDB, has approved a facility of about $17 million to enable the local financier, that's the NMB Bank Zimbabwe, to support SMEs and local businesses. The latest development of the Trade Finance Transaction Guarantee Facility was announced on Thursday. This is AFDB's first project with NMB, a registered commercial bank with strong SME credentials that will provide 100% guarantee to international confirming banks for the non-payment risk they take on NMB's trade finance transactions conducted on behalf of SMEs and local corporates that are active in agribusiness and trade distribution value chains in Zimbabwe. Let's take a break now. When we come back, we do have more stories for you still on the African continent. Just stay with us. You're welcome back. Still watching Business Incorporated here on Channels Television. We head to South Africa, where this week we did see that fall in their GDP for the third quarter, a worrying development, but I guess not so surprising. Well, to help us elaborate on this and give us some of the implications, joining us from Johannesburg is Dr. Elna Moolman. She's the head of South Africa Economic Research with Standard Bank. Apologies for your name, Dr. Moolman. Please forgive me. Welcome to the program.
Good afternoon.
So obviously a worrying development we saw there for the drop in the GDP of South Africa and the threat of recession. How real is this threat?
It is a real threat. So we unfortunately have a number of headwinds. Some are international. So if I think about our terms of trade, in other words, export relative to import prices, they have fallen by nearly 20% from their recent peak. And of course, along with less supportive prices, we have weaker demand for many of the products that we typically export. So there's an international component to it, but there is also a domestic component to it. And this is the part that we're most concerned about, and that could then underpin a recession if we have another contraction in the fourth quarter.
So we saw that the first and the second quarter were positive, and some people were surprised when you look at some of those factors that hit the economy. How come, I mean, did we miss those magic touch that were used in the first and the second quarter?
Yeah, I think unfortunately the context is that we had a sharp decline in the fourth quarter of last year. Now that is when our electricity constraint was particularly severe. And so after the decline, it wasn't that difficult to recover it. We should really see it as a recovery in the first and second quarters. But then in the third quarter, not only did we have a persistent electricity shortfall, but our railway and port infrastructure has also deteriorated quite significantly. And so that is now also becoming a binding constraint to production, because we struggle to transport and export the products. And these are the things that we're really concerned about. But there are also other factors. The agricultural sector, for example, contracted by almost 10%. And again, it's a combination of not having enough electricity. So it's a problem from an irrigation perspective, but we also had avian flu, foot and mouth disease. And so it's really just a number of factors that conspire to give us a very weak third quarter.
So I don't know, have these things changed, or do you see them still determining a negative output in the final quarter and this quarter?
No, so the fourth quarter, we're probably going to see even a worsening at the port situation. So we have severe congestion now that is becoming a real constraint to exports, and it's even worse in the fourth quarter. The areas in which we're seeing some improvement is on the electricity side. So we have two things happening. One is our local electricity provider, Eskom, is increasing its capacity. In other words, some of the big units that couldn't produce earlier is now coming back on stream. So that is helping. And then we've seen rapid increases in private sector electricity generation. So roughly 5 gigawatts of solar power now. So that is at least helping at the margin.
All right. So has the government said anything, about maybe some drastic or intentional moves that could actually help the economy, especially when you look at your agriculture sector? Well, thank God that the electricity supply is improving. And then also looking at your mining, which is a major one for the country. Any major steps?
So the government is working with a longer term plan. So there's no quick fixes, for example, for the electricity constraint or even for the logistical one. You can, at the margin, improve it. But we should really think of this as a multi-year intervention to radically transform these sectors. So electricity, for example, used to be provided only by Eskom. And now, like I've mentioned, we have a massive private sector generation capacity as well. And that comes from government interventions, from reforming the policies that there's no longer a constraint on the private sector to produce electricity, which we had in the past. And we're seeing something similar on transportation. So unfortunately, it's not going to give us overnight improvements on the operational side, but again, significant transformation in the sector. Whereas we previously had a monopoly on railways and ports, we're now getting in significant private sector participation, which is really the solution out of this. The state simply doesn't have the capacity or the finances to fix these problems on its own, and it's therefore down to, fortunately, a very well-developed private sector to assist in alleviating these constraints.
So do you see that a threat of recession catching up with the economy in the fourth quarter?
So we still expect marginally positive growth in the fourth quarter, but we are monitoring the data releases very closely. I'd say I'm a little bit more optimistic about next year's growth. So this year will probably end up at roughly 0.5% of growth. We could have perhaps 1.5% growth next year if we have then the ongoing improvements on electricity, but also perhaps lower inflation and lower interest rates to provide a little bit of support to the economy.
All right. Thank you so much for sharing your perspectives. Dr. Elna Moolman, the head of South Africa Economic Research with Standard Bank. All right, let's go to Kenya, where the shilling was stable against the dollar on Friday, buoyed by the central bank's policy rate hike earlier in the week. According to traders, the shilling was at 153.20 or till about 40 per US dollar, at the same as it was on Thursday. There are expectations that the shilling will hold at this level until the new year. On Tuesday, Kenya Central Bank raised its main lending rate by 200 basis points to 12.5%, saying that the shilling's slide this year to repeat record lows had spurred price pressures, curbed foreign investment, and affected debt servicing. The shilling has lost about 19.5% against the dollar in 2023. Still in Kenya, the government is set to send about 1,500 farm workers to Israel on a 3-year contract amid the ongoing war with Hamas. The Ministry of Labor, through Principal Secretary Shedrack Mwami, says that the two countries had a deal for mutual benefit, where the Kenyan labor will be exported mainly as casual workers to work in Israel's agricultural fields. The deal, according to him, has a guaranteed net income of about 230,000 shillings, that's about $1,500 per month for the workers. The ministry said the casual laborers will be earning a net income of $1,500 every month for the entire period. It further notes that the initiative would be coordinated through Kenya's National Employment Authority. Well, that's it on the program. Thank you so much for being a part of Business Incorporated. I'm John Mekwa. Have a great weekend.